Welcome everyone to the Hurley Investments Trade Finding and Adjustments for Thursday, the 5th of March. My name is Kevin Hurley and I'll be hosting this with you today, as well as some help from Registered Investment Advisor Keeve Bybee. But here's what I want you to first think of, because I'm trying to poke some fun at what's happening in our markets. And I know some of you are like, well, Kevin, this market sucks. There's no fun in it. So let me ask a series of questions that you don't have to answer any of them, but I just want you to think about it. Number one, how many of you, so you know what? Yeah, let me, I'm going to type out the question. So here we go. Number one, how many of you knew the market would react this way? First question, right? Number two, how many of you were caught by surprise? How many of you thought it was over on Monday and that we would, I'm going to get a different microphone in so it won't pick all the typing up. Sorry about that, guys. And that we would go back to new highs. How about repeat question 3 for yesterday? Big question. Will it get worse? Was Monday all about Joe Biden? And I'm going to answer some of these. How many of you want to just bail out of the market? How many of you wish you were never in the market? How many of you are glad to be making up some of the downside movement? It's easier for me after you've gone through something you've seen in 87, 93, 96, 2000, 2008. I don't mean to be making light of this. And in no way am I saying anyone is dumb. But the key is how to not act dumb or dumber. And let's have a little bit of fun with this. This is how we don't want to act. So don't be this person right here. And hold on. We have a question coming across. I'll hold that response just to myself. But here we go. This is how to not act when the market's freaking you out.
Say, are you guys going to Davenport? My car died and I'm late for luncheon. We usually don't pick up hitchhikers. But I'm going to go with my instinct on this one. Saddle up, partner. You're it.
You're at Quincy's. Any Quincy's. You're at Quincy's. No, any Quincy's, no startsies. You can't do that. Can't do. Cannot stamp it. Can't do double stamp it, no erases. Cannot triple stamp it, no erases. Tell Boo, make it true. You can't triple stamp a double stamp. You can't triple stamp a double stamp, Lloyd. You can't triple stamp a double stamp. Lloyd, you guys, enough. Hey, want to hear the most annoying sound in the world? Fellas,
Think we could listen to the radio or something?
radio. Who needs a radio? Ready, Harry? Mock. Yeah. Ing. Yeah. Bird. Yeah. 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 Mockingbird. Don't everybody have you heard?
You heard.
He's gonna buy me a mockingbird. And if that mockingbird don't sing, he's gonna buy me a diamond ring. And if that diamond ring shines, look, there's some people on it right too. Pick them up. I see birds.
I'm sorry, I'm just trying to have a little bit of fun here. If your facial expressions look like any part of that poor gentleman in the car there, you might be in a volatile market. All right, so let me go back and let me bring this around is something that I hope is going to be helpful as we walk through today and things you can do. How many of you knew the market would react this way? I mean, nobody. In all honesty, no one put something out, hey, watch out, we're going to have a virus that's going to tank our market 10%. So don't be disappointed if you are caught by surprise. That happens in real markets. That happens in real trading. The key is, what do you do to make up those surprises? If any of you thought it was over on Monday or Wednesday and we start going to new highs, boy, broaden out the way you're looking at our market. Broaden out and understand the market's never a one-day activity. One day in the market never, ever makes or breaks a portfolio. If it does, I'm just going to tell you, I know of 2 educations that are out of business, and I know two local money management companies that are also going out of business over this. If you're going out of business, if your education is part of it, if you're really, if the last 2 weeks have put it to where you can't manage money in the stock market is not a place for you to be. Get out. Well, Kevin, I can't afford to live. It's the only money I have. It's this, it's that. Get out. It's better to have a guaranteed something than not be able to handle it and push yourself to areas that you can't handle. Was Monday all about Joe Biden? Again, I was trying to say no, but I had no idea what it was. Well, Kevin, Monday was all about Joe Biden. Bull crap. Because if it was, today would all be about Joe Biden, and our stock market wouldn't look at the way that it is. If you just want to bail out of the market, I'm going to tell you with all due respect, you have no understanding of what to do when your market goes on sale. You have no understanding of how to be making money both ways in the stock market. If you wish you're never in the market, I'd love to sell you an annuity. And how many of you are glad to be making up some of the down day today? That's kind of the test. We're looking at 2.5, and boy, we're still at that 0.8%. A comment I know I'm going to get. Well, if if you are not taking on the downside, did you make all the upside yesterday? What do you think the answer is going to be? Of course not. There you go. Thank you for the two of you who just typed that in immediately. Of course we're not making up all the upside from yesterday. That's because we're hedged. That's because the longer term you go and the more experience you have in the stock market, the better it's going to be to help you get through what truly should be a temporary bump in our stock market. With that said, Key, was there something you wanted to add today? Is there something that I can turn it over to you, mute myself, and or have you say, or would you like control of the screen? Type in what you want me to do for you on the comments you were going to make today. Plain and simple, obviously we were not in the all clear yesterday. We were not in the all clear yesterday, so make sure you're not making those amateur knee-jerk reactions. I'm going to go ahead and I'm going to turn this over to Key for a little bit. Key, when you're done, go ahead and turn it back over to me. But let's make Kiva presenter. So Kiva is now the presenter, and Kiva, I think you got to say yes, and make sure I got you unmuted. Looks like you're unmuted. I'm going to mute myself. Go ahead, Kiva. Kiva, just to let you know. Kiva, for some reason we can't hear you. You might want to unmute yourself and or looks like you're unmuted. Maybe it's me. Nope, I should be able to hear you. Key, for whatever reason, I don't see anything coming across from you on the sound. We see your screen, but your sound, for some reason, we're not hearing you. So let's give Kiev a quick second here.
All right.
There you are. All right, I'm going to mute myself. Go for it.
All right. All right. Thanks, guys. I'm hearing my own feedback, so let's try something else here. Okay. So as I've kind of been looking at just the last few times we've had this kind of a situation, a big sell-off, and I don't know, just kind of trying to compare both the chart and news around these times, and just take a moment to digest and also look forward to where things might go. So if you go back, there is a drop pretty similar time frame in 2018 in February. Came down, touched the 200-day, and this was on our S&P, let's see, 2,800 all the way down to 25. So that's 300 points, and that's on the S&P. Every time we talk about hundreds of points, usually we're kind of talking about the Dow. So pretty significant drop there. What that was like about 10% or so. Similar situation coming off of a year before where it just kind of went up and up and up and started even go parabolic where it just kind of even goes steeper up to the market high at the time, the beginning of 2018 from January. So I think there's a few similarities there. So what happened back in this time? If you guys remember, there was a big computer algorithm drop sell-off from that point, and it had to do with the 10 and 2 year, the inverted yield curve. If you don't remember that or that doesn't make any sense, you can Google it more, but that's what happened there. And it was a quick move. These were several, just a couple of days going all the way down. But we had the support of the 200. And we had some pretty violent swings through that period for a few months after, and another pretty big drop through March. So going back to the next one, that was beginning of 2018, and this bunch here through this period all the way down to here was, let's see, September, through a pretty wild swings to continue those from back in March of 2018. And then if you remember, the sell-off here in December was even more. So kind of around October, beginning of October, all the way to the day before Christmas. And man, those days were pretty crazy, just to drop from 24-ish, 2400-ish all the way down to 23, all the way back up to 25 in a matter of days was kind of nuts. But so what was going on here? So we had more of the same that we had in this period, which was again that yield curve algorithmic trading kind of causing some worries. So more of that here, and then a few things kind of stacked up as far as news and sentiment, and we had a continued drop off where at this point we were thinking, well, maybe we'll get at least a Christmas rally. That didn't happen. We had, or at least not through December, right? I guess you could say our Christmas rally was the beginning of the 2019 year. But this period we had not only the yield curve going back and forth, going negative and so forth. We had Powell saying that we needed to increase rates. Trump tweeting, Powell, you dummy, we need to lower rates. And then I think we got a rate increase in December was one of the big things. Maybe you can correct me if I'm wrong there, Kevin. I'm pretty sure it was something like that. And then it was kind of reverted soon after the beginning of the year that helped drive the market up through that period in 2019. And then the other thing was trade wars and just the uncertainty there, and all of those things kind of stacking up to cause a sell-off towards the end of that year. So what are some differences? What's the difference between those and where we're at right now? Well, as far as the time of year, again, we're here in February, March, similar to February, March 2018. Our news is a little different. We have a virus. Both are kind of a black swan type of thing, and that 2 and 10 inverted yield curve is more of a economic leading indicator that suggests that sometime in the near future there will be a recession, and that's what all of the algorithms were cued in on. This time it's simply the uncertainty of how much this coronavirus is going to affect things. So I guess as I'm kind of looking back and trying to see some similarities, some differences, we have a trade war that's kind of come back quite a ways, that we had a partial deal, so we have less of that. We have coming up the new bonds out in Europe and their whole issue out there, and solvency issues and problems they have will be some uncertainty here coming in the next few months. We've got an election towards the end of the year, last quarter. So yeah, so maybe that will be more relevant on something like this time frame. But again, if we get a Trump re-election, that will be a positive thing, most definitely. So just kind of going through those, thinking of differences and similarities. One big similarity I'm thinking we'll have to deal with here is all of this choppiness after our initial drop, where we have 7-8% swings through a matter of months, swings through this period. I do think that to some degree, investors are wanting to seize an opportunity to buy the dip. And I think that's the reason we've had this bounce here. But again, kind of a similar percentage swing, a bounce back a bit. But I kind of feel like we have still some uncertainty to deal with. Just getting kind of a feel for people's emotions as I've scrolled through my Facebook feed and seen the articles and discussions people are starting. Most people, I think, are getting the idea that the coronavirus issue as a whole is way overblown, and we're making fun of people going to Costco, buying all of the toilet paper and wipes and all of that up. So I think there is somewhat bit of a paring back of the fear. So I think that's why we're kind of coming back the other way. And Yeah, I guess now is the period where we try and not get swung out of a profit in the meantime. It was fantastic to be able to book a profit on the way down on some protection. And I guess, Kevin, to turn things back to you, maybe go over some of our discussions on how we manage this going forward, because it doesn't necessarily have to follow exactly how things have gone in the past, but yeah, there's definitely some swinging that I think we're going to have to deal with here in the next few weeks and months.
Thanks, Keeve. That's how would I say it? It's important to look back at the past, and that's how you work your way through some of the positions that we're in today. Keeve just showed you we were in something similar to this. It's been twice as bad 2 years ago. 2 years ago, when he's showing November, December, January of 2018, 2 years ago, we went through a 20% drop. So you go back and you look at what's happened in the past. I actually used to work for a company called Spread Trade Systems, and this is 2018. What we're looking at doing here in the future, when you're caught in between some of this downward and upward movement, you need a strategy that's going to work. And the neat thing is, take a look at some of these dates on these positions. 11% return, got in on the first, got out on the second. It's a SPY straddle, a 90.89 straddle. We booked $624 on a one-day trade. This is looking back in the past. What's worked in the past when you have a similar situation? Oh, there's my family 10 years ago, 12 years ago. Only had 4 boys, no girls. This is where I'm supposed to tell you, when you're having a hard time looking a little bit longer term, figure out what matters most to you. Again, another trade, amazing trade, loved it, but this was an 8-day trade. An 8-day trade that netted $596. Looks like this was a 4% return. If we were to go to our next one, a 10-day trade. This one was kind of a whopper, $3,700. 16th got in on the 6th. So really, as we're looking at portfolios, we're going to start inserting what's worked in the past. This one happened to be a 49% return in 3 weeks. A Q trade that apparently was currently open when we took this shot, that was upside down. Wait a second, you mean not all of your trades that happen in volatility work for you? Of course not. Here I don't remember, but we have a couple days where, for all intents and purposes, you might look at the trade and go, you guys are screwed. Or you make an adjustment. In this place, we added a short call. And now when you do the math, yeah, we're down $2,800 on the call instead of $2,000, but we're up, we're down $2,180 on the call instead of $1,000. But by adding the short call onto it, we actually are up overall in the trade $2,800. 28 minus 22, you're up $600 in the trade. I'm trying to show this to you because as we look at your portfolios and what we've gone through, we need to add some short calls. Hey, we've got volatility that's now up at 18 or 19. As soon as we're done here, Keeve and I are going to try to take advantage of the volatility. That's about the highest it's been today. So we're going to reset portfolios right now to help you guys by having positions in place that will take advantage of the next up day, that will have that volatility crush and bleed off. Where since what's left when we were stacking downside hedging positions, we can go ahead and we can take the cues and hey, let's pick up some more money. This is way out of the money. Let's go ahead and let's do something where, well, we actually already have an order here. So let's see if we can't cancel that or change it just a little bit. Trying to give me a second to get this open. Come on, internet. Actually, I think this is on E-Trade. You guys might have noticed it. We're trying to get an extra $1.10 across 9 accounts. We're actually, what we're trying to do is roll. So I'm just going to redo this one. It might cancel it. It might not. All we were trying to do is take advantage of volatility. This used to be a 65 to 70 cent position. So what we're doing is we're taking these cues, the short ones that still have $3 of value in them. When we did the math, we had about $3.60 of risk. Might not get down to the 200s. So we're taking these positions and rolling them just up in strike price. All we're trying to do is find, I think we went from 90 to 196. We're trying to find an extra dollar. So our risk in our hedge goes from 360 down to 260. And boy, we're close. We got it set at 110. Look at the ask. If we have a drop down today, we're going to pick up a position yesterday that we could only get 65 to 75 cents for, yet still have a hedge. On the other side, we need to take a look at some of the positions that we have. Let's go ahead and take a look at Boeing. For some of us that are in Boeing for the stock ownership side of things, maybe even for the leap calls, it's time to say, hey, how can we go ahead and grab some profits here? So let's look at 1,100 shares. If we were to look at Boeing, we know we have an earnings far out there in time. We're just going to try to get through March, right? Maybe an April 3rd, a March 27th. Boeing's down at 266, may not get up to 300 again, a round number. We're looking at most likely pretty quickly here. God, that's not even showing enough. Let's go to 40. What if we could take off $3.70? What if for the next 3.5 weeks, we go ahead and we take $3.70 at a 300, a round number resistance level on Boeing, create some income, do it when volatility is up 19.5%. That's an option for Boeing. Disney kind of sucks right now. We get it. Yes, we've got good protection on, but Disney right now breaking through 114, probably I think the next level down is 106. So what if we went up to something like, what if we went up to something like 121, above the 120 resistance level, which has 115, 116, 117, 118, a bunch of levels stacked up right there? What if we could get another $1.80 on all the Disney shares or against a leap long call position? This is what we're looking at. This is the next step in finding ways to create value in portfolios. Keith and I would normally do this towards the end of the day. And I'm sorry, I've got someone's expecting a call from me at right after this. Looking at the volatility, I'm going to need to get on the phone with Keith and Jeffrey T. Smith, and we need to take advantage of this while we have it interday. While the East Coast is going to lunch and volatility is spiking, we need to be adjusting some portfolios. I'll admit, today, I love on an S&P that's down 2.89 that we're not even down the full 10%. We should be down 130, excuse me, the full 1%. At 130, we'd be down 1% in these accounts across the board. Again, we're beating the market by 2/3. I'm okay with this. I'm okay at weathering the up and downs and positioning ourselves for when it does really take off, we're going to be in great shape. That's what we're doing. Any questions today on anything that we presented to you or the next steps that we're looking at Hurley Investments? Let me give you guys 30 seconds. Keith, I appreciate you going through some past history and reminding us that just 2 years ago, the end of 2018, beginning of 2019, 2019, excuse me, end of 2018, beginning of 2019, the volatility that we went through. Thank you for pointing out on those charts. Hey, we went through 2-3 months of choppy sideways. That's what we need to be reminded of. We need to go back to history and see where we're at. I don't see any questions coming in. Guys, have a wonderful day. I do hope this was helpful for you. Jeff, we're going to try to get this posted as quickly as possible. I saw you ended up a little bit late, about 20 minutes late here today. Let me get that out there for you. And the call that we're supposed to have, Keith and I need to take care of some volatility here. So please feel free to give me a call later. I don't know if I'll be able to pick up right away, but sometime today I will get back with you. Guys, don't forget to go back to the past. The past doesn't always guarantee future results, but it gives you a roadmap of what could be coming. And if you have some experience, as I did, go back to what was making money in 2008. Go back and start to use the knowledge you have or use someone else's knowledge so that you can actively affect your portfolio for the better. Guys, have a great day. I appreciate you being here with me. Bill, glad to have you back. Hopefully you enjoyed your trip. And boy, 2 big up days, 1 big down day. It was a pretty easy time just to sit through and not have to do anything. But Bill, I'll give you a call here in a bit as well. Guys, have a good day. I'll get this posted immediately. And man, let's make it through this market. Look forward to seeing you next Monday. Goodbye.